In our today's video we are going to learn, why is diversification important for your investment portfolio? So let's go. Diversification is a fundamental principle of investment that involves spreading your money across a variety of different assets and investments. It is essential for your investment portfolio for several reasons. 1. Risk reduction. Diversification helps reduce the overall risk of your portfolio. Different assets and investments tend to react differently to various market conditions and economic events. By holding a mix of assets, a downturn in one sector or investment may be offset by positive performance in another, cushioning potential losses. 2. Smoothing returns. Diversification can lead to more stable and predictable returns over time. While individual assets may experience fluctuations, a well-diversified portfolio can smooth out these ups and downs, providing a more consistent growth trajectory. 3. Opportunity to capture market upside. Diversification allows investors to participate in different segments of the market and seize opportunities for growth. Even if some assets experience slower growth, others may perform well, contributing to overall portfolio gains. 4. Avoid overexposure to a single asset. Relying heavily on one asset or investment exposes you to significant risk if that particular asset underperforms or faces challenges. Diversifying reduces the impact of any single investment on your overall portfolio. 5. Customization to risk tolerance and goals. Diversification allows you to tailor your portfolio to your risk tolerance and financial goals. Conservative investors may choose to allocate more to stable assets like bonds, while those seeking higher returns may allocate more to equities. 6. Hedging against uncertainty. In times of economic uncertainty or market volatility, a diversified portfolio can act as a hedge. It provides a level of protection against unexpected market events. 7. Access to different asset classes. Diversification enables you to access various asset classes, such as stocks, bonds, real estate, commodities, and cash. Each asset class has different risk and return characteristics, adding to the overall diversity of your portfolio. 8. Long-term growth potential. Diversification is especially beneficial for long-term investors. By spreading investments across different assets, you increase the likelihood of capturing growth opportunities over extended periods. It's important to note that diversification does not guarantee a profit or protect against all losses, especially during severe market downturns. However, it is a prudent strategy to manage risk and enhance the overall performance of your investment portfolio. The level of diversification that is suitable for you depends on factors like your financial goals, risk tolerance, time horizon, and investment knowledge. A financial advisor can help you design a diversified portfolio that aligns with your specific needs and circumstances. If you learned something valuable from this video, make sure to press the like button and hit that subscribe button.